I hear, whether it's on Twitter Spaces or talking to people or reading some think pieces, that, crypto is crashing, the Federal Reserve, it has to save crypto. This SPAC is crashing. This highly speculative company is worth 5 cents on the dollar, what it was a year ago. The Federal Reserve is going to come in and save me. Joseph, why is that thinking flawed? And why is just focusing on inflation the right way to go?
Yeah, those guys need to wake the up.
Two special guests today. As always, we have Joseph Wang, former senior Fed trader and author at fedguide.com. Today, we also have Nick Glinsman, who's worked with some of the biggest macro hedge funds in the world and is an author at Intelligence Quarterly. Gentlemen, welcome to Forward Guidance. Nick, can you just introduce yourself to the audience? Who are you? What's your background? What sort of markets have you been working in?
Sure. So my background, which will probably give a pretty good clue as to the markets I'm originated from, is Merrill Lynch, late 80s, where I ended up helping to build the European government bond effort, sales, trading, and research. And then I moved on to Salomon Brothers, where I ran futures. And after that, with a little bit, we set up my own hedge fund with a couple of Salomon colleagues, and then did a little bit of a sabbatical out of the business, and came back into the business and was in and out, primarily working as a macro portfolio manager for Brevan Howard, both externally and also in London and New York, which from a professional point of view was my favorite time. I love Salomon Brothers. Brevan was the calm version. It was like working in a library surrounded by people you could learn from every day. And it was, everybody was treated in that way. So it was really top quality, and you had, enabled me to create a really relevant network, which comes in very useful during times like this, but even other times, but really useful right now.
I hope this is how I view this podcast, is a quiet library where I'm surrounded by people I can learn from. Nick, I would add, if it were just you and me, I would ask you what are the lessons you've learned on your career, but things are too crazy right now, and we've got Joseph here, so let's just get right into it.
I'll give you one lesson, and it came from something that my uncle, who's not in the business, once said to me. He said, around every street corner, there is a banana skin ready to slip you up, and that's how you should treat risk management. That's been stuck in my head for decades. Beware the banana skin.
Well, there are a lot of banana skins in this market, and there are a lot of investors who have been caught unaware and have slipped. So many so that the market has tanked today. They were recording Friday, May 13th, is a reversal day. We're having stocks are going up, and some are saying, we've reached a bottom. You, Nick, are not so convinced.
Yeah, if I'm looking at things, I wrote something down actually, because I wanted to list it. I figured we would have that conversation. And I'm just thinking, I watched a program on financial TV. Somebody said the US consumer would not be bothered to curtail spending. And I'm sitting there going, really? Record gasoline prices, record diesel prices, 8% inflation, 11% PPI, rents going through the roof, food inflation, potentially going much higher, and we can have a little chat about that later. And this is all offset by cash holdings and wage growth. Strikes me that we've got issues. Wages haven't kept up with CPI. As far as cash holdings are concerned, I'm just wondering how much damage the debacle in crypto has done. When you think that a lot of the cash holdings, there's this meme going, stimmy checks, meme stocks, tech stocks, crypto. So you wonder how much damage it's done there. And then you look at, what was lost in the FANGs is sort of more than 10% of GDP in value over the past 6 months, which was, I think, we could forecast that the technology was going to hit a hard spot, because I've always used the bond market as, that's my tool. That's my basic tool. I can't do anything else without the bond market. And it became very clear to me that there was a point, I think mid-December, I had a high confidence yields were going higher. So that was a trade we put on. And if yields are going higher, often there's a lag time. And, normally that lag time can be 2-3 months. I think back to Fukushima. You knew the stock market was going to go down, but it took a couple of months before it would happen. This time I figured, since then everything's compressed in time series, that it would be quicker. And I sort of anticipated New Year. And everybody said, but there's going to be a whole load of allocations. And I thought, let's watch the initial price action. It wasn't great. It didn't suggest to me new allocations into equities. Bang. Okay, short NASDAQ, short S&P, and short the most long-held stocks. Those that were really, really very visited and held with gusto by the market, whether it's professional or retail. I'd just say the market in that case. So that became very clear. And then I was never in team transitory. If you were to describe me in terms of what do I think about the central banks, I'm in the tradition of back hot. Okay, back in the 18th century. And I just felt this is a Fed that is, certainly since the GFC, but I think beforehand, it strikes me that the central banks have moved from using economic cycles to avoiding economic cycles. Okay, and they felt that their job had moved, because of the deflationary forces that were around, they felt their job was to suppress volatility. Okay, now that was peak independence of those central banks. And if Joseph's read my piece today, I did a little historical study about independent central banks was a deflationary low inflation period. Prior to that, those banks were not so independent and very subject to political pressure. And we're now back at the same thing, which would imply, if there is that correlation, and I think there is, inflation. Okay, so it just struck me that if we've got a Fed that's behind the curve and a Bank of England that's behind the curve, and the ECB acting out the ostrich position with the head in the sand, well, if I was of the view that we'd already had policy errors, that will continue. And I even think what the Fed has done now, it remains a policy error. I don't understand why Powell has taken off 75 basis points. I don't understand why Powell has been so specific on 2 rate hikes, more 50 basis points, and then we'll see what. We could go every meeting this year with 50 basis points. And if you're going to, conceptually, if you're going to think about, okay, we're going to 3 meetings, 50 basis points, it's pretty much said it. Okay, go do 1% the first meeting and 50 the second meeting. Why wait? And why have this, why wait to start QT? They waited, that should have stopped last year. Or QE should have stopped last year. But they've been doing QE until, boom, now they're going to suddenly do QT. These are all mistakes. You've been greasing the wheel. And what they've ignored, even though they've clearly become more politicized, I think they've ignored the fiscal grease that's been applied throughout COVID. I think the last one was way too excessive. Thank God we didn't get Build Back Better. That's another policy error. And if you think back to the old days, even of Greenspan, who was probably the heir to the first policy error of the put, he used to mention fiscal. Well, if fiscal is a bit tighter, we can be, it used to be part of that conversation. And it used to be that counterbalance, the true Keynesian counterbalance, right? As opposed to the new Keynesian. So I think we've gone away from that. And I think there's this fear of allowing the economic cycles to, you smooth out the economic cycles, but allow them to do the adjustment where there is too high a pressure that's going to act negatively for the economy and thus for the population. And I still fear this Fed. I don't trust this Fed. I think they will. I'm still looking, if we get dips in various measures, probably unemployment is the one, but they seem very ready to, every time there's a little bit of the Yellen China's not doing well. I'm not going to. And she was given a free pass in the markets, and she didn't take it. So I think it's a bit less of that, but I'm still worried about that in this Powell Fed. And I think, the Bank of England have taken a very interesting course and said, look, we've got to inflict a bit of pain here. Be ready for some pain. Yes, the government can adjust according to, but we have to inflict a bit of pain. Well, the Fed should say that. Now, I have heard it's something interesting, though. There is on the Hill a bipartisan movement. Okay, but before that, apparently what was agreed in DC during the IMF. Are you ready for this? I noted this down for today. Okay, rates are going up everywhere. Lagarde has signed off. The mantra is, we hang together or we die together. And it's inflation, inflation, inflation. Now, if that, that's like sending them up to Star Trek and bringing them back down again, and their whole DNA is slightly changed. So my reaction to that was, I'll believe it when I see it. However, I've been a little bit encouraged by some of the Fed speakers and some of the ECB speakers suddenly turning quite hawkish. How can you not? Their whole transitory argument had been completely discredited. Powell last night basically admitted error. How can we, they've done one huge error, transitory, which I think is partly they got into a bubble, which was self-fulfilling. They just convinced each other it's transitory. But I also think partly the forecasters at all the central banks have a bias. The best porcupine chart I've ever seen is the ECB's. You got your 2%, deflation down here, but we're going to come back. And now inflation's up here, but we're going to come back. And that's the bias. And the policy, they've either got to change their models. One of the problems with these models, particularly if you take the ECB uses commodity forward curves. How can you model monetary and guide monetary policy on commodity forward curves? Did you see that chart I put in there of European gas prices? 5 months, it was backwardation down here. 5 months later, it was up here. You can't possibly model according to that.
Even I know that you're not supposed to do that.
It's not a forecast,
current price
right?
of oil. The current price of oil is 100, and in 2 years, the forward curve indicates it's 70. The market isn't predicting that it's going to be 70. That's just a indication of supply and demand. I gotta get Joseph in here. Joseph, Nick has given us a lot to work with. Go ahead.
No, I agree with you, Jack. You're exactly right. I remember there was a discussion on Twitter between Javier Blas, one of Bloomberg's best commodities reporters, on this, actually. And I was surprised to be reading some of the ECB speeches and noting that they were using the commodities forward curve as a market's prediction for commodities, whereas it's, as I understand, more of a tool that a lot of the producers use to manage supply and demand rather than the market's forecast of where prices will be. So it was surprising for someone as important and sophisticated as the central bank to make that mistake.
I've never traded using the forward curves on commodities, and I've traded a lot of commodities in my life. And it's the beauty of the commodities market is you've got price action, but you also you can gather the data on supply and demand. This is another issue which was part of, I did not believe inflation as transitory, was this move at Glasgow to net zero, the COP26 move to net zero, and no transition plan. Are you crazy? Talk about, this to me was the equivalent policy error done with good intent that creates legends in trading. And I'll go back to a policy error, sterling crashing out of the ARM. The British tried. The extraneous factor was Schlesinger, the Bundesbank. I don't care about British or the Italians. I'm doing this and to hell with everybody else, which was, that's the mindset of what's going on in Germany right now, in the inflation side. And the British tried to stay in. It was done with good intent, right? And I remember, I remember the weeks before, people say Soros broke the Bank of England. Let me tell you, that day where sterling came out of the ERM at Salomon Brothers was the greatest single profitable day in the whole of that company, and it was the London office. That's how we were positioned. There was that trade. But there was the short sterling strip trade. There was gilts. There was the equity. I mean, there was so much you could have done. And it was just, that was as in investment banking, that was probably the best year for a lot of people. A lot of people. So I felt this transition to net, you can't transition to net zero without a transition plan. Without that transition, immediately that's inflationary. And we've seen that, absolutely seen it. And this, we've had years of equivalent ESG, less capex in the fossil fuel sector, a move against uranium and nuclear, which makes no sense to me. And then you figure out all the metals that are needed for ESG product. They're dirty to mine and they're dirty to refine. Okay, so did you know an electric vehicle? I read a report. An electric vehicle to get to net zero, good for the climate, takes 50 years, given all the fossil fuel and carbon used to make the car and the batteries and everything. So you can't do that. You just that. So that was a huge inflationary force. COVID started it, but boy, did it get a surge after COP26. And then you had sloshing around huge liquidity, huge amounts of reserves at the Fed. This was all just geared to an problematic inflationary outlook. And now we're seeing I think we may have peaked, but I think what we'll do is what we did in the 70s, come down to a much higher plateau than the 2%, and then we go back up again.
So Nick, you've been completely right on this, but just thinking about it from the Fed's perspective, when you talk about Powell just going 50-50, when you listen to what he's doing, like he's not really saying that he's going to lift monetary policy to where he considers to be restrictive, right? He's trying to get to neutral ASAP. I mean, we were speaking with Jim Bianco last week about this, and it seems the implication seems to be that Powell may potentially still actually believe that inflation is transitory because he thinks that maybe if he just waits a bit, it'll go away. Do you think that's the right interpretation of what his actions rather than what he's saying?
I think Jim was perfectly correct on that. I think I've said privately, I haven't written it, quite a lot of policy is written with hope and prayer, which is not a good policy tool, right? You've seen what's happened in Europe. There was huge hope, and Lagarde has finally signed on and said, they'll stop QE next month, and they'll start raising rates the month after. Their problem, of course, biggest problem ECB has is it's not a lender of last resort. It's not meant to finance individual governments. They got to tighten pro-cyclically, given what's going on with the Ukraine, and they've got all these peripheral spreads that they've got to manage. I speak to a lot of Italians who are in finance, who are industrialists or policy. There is a conviction that Italy's already bankrupt. So the question is, and Draghi's done very, very little structural reform. So the question is, at what point does that actually occur? Will the ECB allow it to occur? And then you could have this strange situation, which is going on in South Korea right now, of ECB raising rates and still doing effectively QE to support the periphery. How's that going to work on inflation?
I remember there being a recent ECB speech. I forget if it's Schwab or Lane. They were noting, basically saying that, we will not let periphery spreads widen. Do not short that. But they were willing to let the euro weaken, though. So basically, do not short the periphery spreads. But if you want to short the euro, fine, we don't target that. So it seems like they were willing to police those spreads. But as we see, it's happening in the euro now. It's
the euro is on the edge of the precipice.
Yes.
I put out a chart yesterday on Bloomberg Chat. 103.50.70. Below there, it's goodbye. We're going to parity. Parity is only a nominal figure. We're going, 90 cents. They see it's very much still the mercantile thought process that's going on with Europe and the German mercantilist thought process, because they're not benefiting as they used to for a weaker euro. Because Germany, if you look at German industrial production, for example, there's a positive correlation with Chinese imports. Well, we know what's happened to Chinese imports. And the correlation is just great. So we know what's going on there. So they're tightening pro-cyclically, and yet they're willing to let the euro go. So if the euro is not beneficial for industrial production and European growth, a weak euro, what's it? Oh, blimey, it's damned inflationary. So it's like a vicious circle for the Europeans. Whereas for the US, a stronger dollar, that actually may be part of the plan. Nobody's spoken about it, maybe with the exception of Yellen, although Yellen gets lost in labor economics and all sorts of stuff, but now that she's at Treasury. But that, to me, there's a clear potential weakening of inflation would be the dollar. But I think they're still hoping. I think it's hope and prayers from these central banks. And as I'll go back to what I said at the beginning, I think Bailey, the governor of the Bank of England, has been the most realistic orator on this whole subject. You're going to get pain. Yes, maybe the chancellor can mitigate pain to those really in need, but there's going to be pain. So I think that's sort of the dichotomy they find themselves in, and it's all because they've acted too late. And I would add, not only have they acted too late, but I think they haven't been watching the fiscal side as they used to.
Larry Summers has a comment that I thought very interesting. So as you know, central bankers like the Fed like to think about interest rates through the lens of the neutral rate. And Larry Summers' comment was that, let's say the neutral rate is a real rate. Let's say it's 50 basis points. When the Fed is talking about neutral being around 2 to 3%, they're really just assuming that inflation goes back to let's say 2-3%, right? But if it doesn't, if inflation is as it is right now, neutral rate is actually several percentage points higher than it is now, right? That's much higher than the market is pricing. I mean, do you think
with the stock market on that rate. I agree with Larry, but the one thing I would say is we never know what the right neutral rate is until after the event. With hindsight, you get a good view on what the neutral rate was, but you have to make certain assumptions. My assumption, and I think Joseph leans in the same direction, is we're not getting back to 2% inflation. And with a high level of inflation, that by definition is going to mean a higher neutral rate.
How high do rates have to go? How much shrinkage in the balance sheet do we have to see for inflation to get back to 2%? The Federal Reserve, all they can do is tighten financial conditions. They can raise risk-free rates. They're doing that. Nick, you say they're doing it too slowly. The dollar can go higher. It already is. It's exploding higher. Yeah. But then there's the credit markets and the stock market. Joseph, when we first spoke 6 months ago, you said the Federal Reserve needs the stock market to go lower to destroy wealth. The wealth effect has to work in reverse in order to destroy demand. It's kind of unavoidable now. Now pretty much everyone accepts that, but they say, oh, the S&P 500, it's 18% drawdown. We're only 2% away from an official bear market. Then that will cause the Federal Reserve to pivot because there's going to be a recession. And there's this thought that a 20% drawdown in the S&P 500 is sufficient to destroy demand. Do you agree or disagree? And please tell us your views in great detail.
One of the interesting things about the post-COVID world is that labor participation rate was so low, right? I'd speculated before that it may potentially be to a wealth effect. You had so many people making so much money that they probably didn't really need their old jobs the way they used to, right? there's some work from the Federal Reserve showing that a lot of it is also retirees not going back to the workforce, like retiring and not coming back. I assume it's because their home equity went up so much, their retirement portfolios went up so much. And if you're a young person, maybe you were into crypto and you made a boatload in crypto. And now I guess we're finally going to test that theory to see if, we will have an uptick in labor force participation since after what happened in the markets, especially the more speculative parts of the markets. And if that's the case, I think that will help inflation because it increases the supply of labor. And so that kind of pushes down prices a little bit. We'll see. I suspect though, and I think Nick, based on what I read in your Twitter dialogue, you probably think we still have a bit further to go though for our fall in risk assets. So,
well, I do because, and I wrote about it today in my daily piece. 20% is one. It's very arbitrary. I still can't figure out where that actually came from. But also, given that it's arbitrary, remember the wealth you were talking about labor participation rate during the pandemic or subsequent to the pandemic was still way above on equity side where the pandemic is. Actually, letting the stock market perhaps fall down to that level creates the financial markets tightness that will induce some demand creation and alleviate some of the inflationary pressures, particularly on the wage side. That's the one we have to watch, because there is a trend towards increasing unionization in the States, as there is in the UK, and that's usually inflationary, and that takes you back in the thought process to the 70s, right? So that's one possible way of further tightening the market in a quicker fashion, rather than doing rates. And I suspect, the other thing is, and I think the market hasn't got this, market's still talking about Fed put. The put was relevant during that period, which has lasted, I guess, since part way through Greenspan, whereby forward guidance was used by the Federal Reserve to suppress volatility because inflation was disinflation. We were in disinflation, right? So you suppress the volatility, forward guidance worked very well. Well, it doesn't work in this environment because whatever they say can be hit with another piece of data, and everything they've said has just become irrelevant. So in fact, they may want to suppress volatility, they shouldn't, and they can't. And that increased volatility works both ways, but what people are now experiencing is, boy, can it work on the downside much. And typically, people say to me, oh, you love these bear markets. As long as markets move, I don't care. But what you do find in a bear market is that move. So you moved up, say, over 10 years, you can lose that in 6 months. So if you're trading well, your satisfaction is much more immediate, as it were. So things are much faster on the downside. And I just don't think people have really understood. I don't think people have understood the damage that has happened in the crypto market in the last week or so. You can go onto Twitter or you go onto various pods and you see people in absolute shock. They haven't understood, okay, if you take something like Bitcoin and you make it a financial asset where there's leverage and margin, well, this is what happens. And so I think we've got a lot of people suddenly experience margin call for the first time. And the other thing that, people are saying, well, the market is short. Is it? I'm not so sure. People are still sitting on great profit, even institutions, great profit from that pandemic low, which was a marvelous opportunity. I even know somebody that effectively bought crude oil negative. I mean, that was you couldn't really, I couldn't do it because I'm no longer at the institutions I used to be at. But the point, so there's a lot of wealth in there, and that wealth may have become too relaxed. So my thought process is there any reason why we don't go, even if we get down to where we started off from pre-pandemic, is that too much of a problem? Because that period of the pandemic looked after itself. And now let's get back to the real world. So that may be the possibility. I think there's and I think I think that Larry Summers' point on the labor force participation rate, I think we'll find that pans out exactly as you intimated there. And we have to get normalization. To me, is not just normalization of markets, normalization of rates. It's normalization of the economy. What was normal in the economy? It was pre-pandemic. So is that such a terrible place to get back to? We all felt pretty okay about it. What's going on with China and the lockdowns, which will hit through supply chains again, which is another inflationary boost. So unless they meet that inflationary boost, because that will take several weeks before you see all these ships outside the US ports and the European ports. Unless they get rid of that now, that will be another inflationary boost, surely. It's sort of, we've seen it before, not only a year or so ago. What's happening is going to happen again.
Today's episode is brought to you by me. The Forward Guidance podcast is looking for a sponsor. I'm very proud of the content that we've made over the past 8 months. A lot of macro has happened. And I'm especially proud of the fact that all of the content has been free. You don't have to be a hedge fund manager, portfolio manager. You don't have to pay thousands of dollars. It's all free. However, you have to support that free content somehow. And yes, we would love to have a sponsor for the show. So if you would like to partner with the show and you think our brands align, and you'd like me to read a message for you to the audience like I am right now, let me know. This is not a joke. This is not a drill. If you are a serious applicant, you're seriously thinking about this, email me at jack@blockworks.co. That's jack@blockworks.co, not .com, .co. Let's get back to the episode.
I think the points that you made on this, like for example, energy and the green energy transition, materials, things like that, those are very, very good stories, and they make a lot of sense as being good areas to look into. But I've noticed that over the past few weeks, they've kind of gone down with everything else, right? If you look at the copper miners, for example, or the aluminum producers, do you think this is kind of like when we're in a downdraft, all the correlations go to 1? Or
yes.
Is it just not time yet to be looking at these
sectors?
No,
I think all the correlations go to 1. And you know what? What happens in a big liquidation phase? People always veer to those positions they have profit in to sell. Whereas in fact, what they should be doing is selling their loss makers before their profit makers. So, you've been, I'm sitting here being patient in terms of when I go back and really get fully exposed in commodity sectors and the commodity equity equivalents. Although I have to say, I felt, even though you take a mark-to-market hit, I felt reasonably calm with the agricultural and even the fertilizers. I mean, Mosaic's taken a hit, but so what? There's no answer to that. And if you do the work, you'll see that Europe is going through a really dry patch. So even though the European Union is, for grains, self-sufficient, they may have a deficit in production. Last year's crops from Ukraine are all in silos in Ukraine, so they're not available. Fertilizer, people have been paying 5 times last year's price in the States, never mind what they're trying to do in Europe. So food is a real problem. And you can, I think, this is what I worry about with the central banks and the speed at which they're moving. Inflation can become very quickly ingrained in the psyche. And what they have to try and avoid at all costs is a wage push spiral. Now, we're seeing increased unionization. You've had Amazon in the States. But that is, by definition, an inflationary set of conditions. And that's not my criticizing unionization or whatever. It is historically, you've always seen that with higher inflation. I mean, Germany, I think the benchmark union, IG Metall, has just come out with an 8.2% wage claim. 8.2. Even the staffers union at the ECB put in a 5.5% claim for a wage increase. That's the ECB. This was before they got hawkish, so this was about 3 months ago. They put in a claim for 5.5% increase. I thought that was a tell. To me, that was the biggest tell of all, because I presume the forecasters are in the union. Everything's unionized in Frankfurt. So I just think that's what they've got to. People are saying it's demand destruction. And they're also saying there's a big problem with negative real wages. But actually, if you're going to get really ingrained, if inflation is going to get ingrained in the psyche, it's going to manifest itself with high wage push, right? And that would be the danger, because then that becomes cumulative. Because definitely we're seeing, all CEOs that you listen into the calls are happy to pass on the prices.
So you're thinking that we could have a wage price spiral?
That's the danger, because the wage price, if you go back to the 70s, yes, we had two shocks. We've had two shocks now. COVID, Ukraine, right? We could even have a third shock at some point. But the thing that really made inflation endemic was the wage price, the wage push spiral. That was, certainly in the UK, but also in the US.
Joseph, Nick has laid out a whole series of inflationary pressures over which the Federal Reserve and central banks have essentially no control. Everything from weather to unionization to ESG to deglobalization, reshoring, onshoring, zero COVID policies in China. The Federal Reserve, they have no control over that whatsoever. So therefore, do they have to tighten even more on that which they do control, essentially financial conditions? And I'll go back. Do you think the terminal rate now of what is it? Barely over 3%, is that sufficient to destroy demand, to restrain inflation? And also, what do you get when you throw QT in there?
I think so. Jack, you're exactly right. A lot of these factors are basically supply side, right? So Fed can't really do anything to help fix the crops or let's say whatever is happening in the supply chains in China. But if you listen to what Chair Powell says when he's asked questions like that, he'll tell you that he thinks part of this is also a lot of demand, and that goes back to the enormous fiscal spending that Nick has also mentioned. So I think that he thinks that he can do something to it, mostly by trying to tampen down on that excess demand that's been developed. And so that's going to happen through the reverse wealth effect, as you alluded to earlier, Jack. Whether or not 3% is high enough to take enough wealth out of the markets to tampen that excess demand, I don't know. But the thing is, if it's not enough, then they'll just go higher. So I suspect, as Nick mentioned, that the S&P target that the Fed would be comfortable with is probably a lot lower than where we are now. So today we bounced right back above 4,000, right? So if we were to go, let's say 3,000, around where we were just before the pandemic, I think the Fed would be fine, and that would probably, with more confidence, tampen down on that excess demand. So I think that, but one thing I do think about in that scenario, though, and I don't know what your views on this are, Nick, is that if the Fed is hiking aggressively, so that interest rate differential between the U.S. and everyone else is going to be rather large. That's going to lead to significant capital inflows, I suspect. Wouldn't that be somewhat supportive of all dollar assets? I mean, is it still possible for us to go down significantly in risk assets if we have all this money pouring in from, let's say, Europe and Japan, and maybe other countries as well?
Well, I actually, this is what I think on that. It'll be okay if it goes into the bond market during QT. And if we've got a riot going on in the stock market, then we've seen this week how the bond market can react on a very weak stock market. So I think that wouldn't go necessarily contrary to what they're hoping for.
Sorry, Nick, which is what? We've seen how the bond market can react. What do you mean?
Well, we had a rally in the bond market with the sell-off this week in the stock market, right? So if we've got a flight to quality, which is effectively what Joseph's talking about, with a higher dollar creating conditions where something's going to break abroad, because you just have to look at global volatility, bond market volatility. I always look at FX volatility, 1 year FX volatility, to see as it surges, something's breaking somewhere, right? But if we have this demand for dollars as a safe. That demand for the dollar can be, if there's pressures building that create a negative, I wouldn't say doom loop, but you know what I mean, negative pressure on risk assets, it can go safely into the treasury market. Why not? There's going to be enough treasuries slopping around the system.
More than enough, really.
And that, right. And actually, that would, the Fed can fine-tune stuff. It's got the reserve balances to use. It's got the repo market to use. Well, their biggest problem that they have to be aware of is a properly functioning repo market. Okay? And the more liquidity that comes back into the treasury market, the narrower the spreads, the off-the-runs start trading properly, everything gets healthier. We will not get a fully functioning global marketplace without a healthy treasury market.
I just want to explain quickly for the audience that normally since 1997 or maybe before, bonds, treasuries have served as a hedge to stocks. When stocks go down, bonds go up, yields go down. Year to date, this has not happened. But Nick, you're saying that this week it did happen, and that's notable. Nick, what about if the dollar is surging, that you say that money can flow into U.S. treasuries, doesn't that increase the FX hedging costs for foreign investors? The Japanese yen, the hedging costs must be much more expensive now, right?
I'm not convinced that everybody's been hedging. And it's interesting, to be honest, if you're on a flight,
it'd be a good trade to not hedge, right?
Yeah, no, exactly. If you're on a flight to safety, you don't hedge. You just get in. I'll pick my time to hedge. But it was interesting. So I'm currently in Brazil. Okay. Did you know that the the largest expat population of Japanese in the world is in Brazil? They are huge players of the Brazil carry trade. So they're the ones that have taken the real from 6 down to 4.58. They're the ones that have been unwinding a bit because of. Don't tell me they hedge, right? That's not a hedge you do on that cost account. So I'm in an environment where money is pouring into the US as a safe haven. I wouldn't be hedging. And I'm naturally based myself. I'm dollar and sterling. Shifted a lot to the dollar. No hedging. I did that purposely. So I know a lot of people look at that hedged investment, and you could say that some of the institutional investors, that's to whom you refer. But like the post office in Japan, they'll do versus they're such a huge owner of JGBs, it's always against JGB yield. So that's where you're doing that calculation. But otherwise, you just get into the US trade. We want dollars. Remember, let's take it into the basic side. If you're an American investor and you're investing in European equities, you typically make a lot more money on the FX side than you do necessarily the equity side. So people sometimes forget they're actually making an FX trade, and they're making an FX. So the point is, if there's a flight to safety and it's dollar driven, you're taking the dollars first. Now, what do I do with the dollars? I'll put them in the treasury market. And probably if it's a risk thing, you probably put it at the short end, which will help my yield curve trade. So that's great. That's my thought. Sometimes people, and I'm not being critical of anybody here whatsoever, but sometimes the market is looking for the complex answer when actually the simple answer is what happens in the real world first. In a fast market, something bad's happened, and you're watching an FX trading desk at, say, a Citi, or where I used to be at Salomon or whatever, they're not saying what's the hedging cost. They're saying, buy me. I'll be back to you later for the forward trade, right? For the forward dates and the forward points.
Right.
So,
I was making the assumption when I brought up that point that everyone is a safe player and people don't like to take risks. It's like, in the 2008 financial crisis, clearly, no. They never could have bought a credit default swap at AIG. They're too smart for that, They do.
Well, you see that there is a difference between the 2008 crisis and now. The 2008 crisis was a financial crisis. It didn't really, in the end, do that much to the economic performance. Would you agree with that, Joseph? Whereas what we've just been through is just, the world locked down and we're recovering, and now we've got a war. I mean, this is so, if you think about the fiscal side of this, I've got a book here. It's one of a series of 5 or 6 volumes by Robert Caro on Lyndon B. Johnson. Mm-hmm. And this is when he was president, and you're looking at Vietnam War spending, the Great Society. What have we had? COVID, which I equated to a war, but now we've got another war, right? So you've had this massive... So I'm sitting here thinking that you can't be... You got to simplify. Sometimes people make it too complex. And that's what I find troublesome about crypto and a lot of the stuff that's out there. They're trying to complicate it to make it sound safe, right? An algorithmic peg. I mean, what the hell are you bloody well talking about? It's an algorithm, and algorithms can break, right? So don't complicate. Sometimes we can see the markets and the rationale and people explaining things and trying to complicate things and make things sound complex, whether it's to make them look intelligent or whether on don't make it complicated. This isn't that complicated a business. Putting the structures together can be complicated, but the fundamentals, there's principles, and just stick with those principles, and you'll find you're a bit on safer. And always remember, there's a banana skin.
Yes, yes. I was going to say. Right. Yeah, Nick, just to keep it simple with the Federal Reserve, they have a dual mandate, and one of them is to keep inflation in check. Inflation is out of check, and they're going to tighten until inflation is back in check. I hear, whether it's on Twitter Spaces or talking to people or reading some think pieces, that, crypto is crashing, the Federal Reserve, it has to save crypto. This SPAC is crashing. This highly speculative company is worth 5 cents on the dollar, what it was a year ago. The Federal Reserve is going to come in and save me. Joseph, why is that thinking flawed, and why is just focusing on inflation the right way to go?
Yeah, those guys need to wake the up.
Oh, you're going to get me puffing on the vape. My
God. Jack, I see people talk about that all the time. I mean, my gosh, people really misunderstand what the Fed's purpose is, right? It's not really to boost equity markets. I think maybe you can think about them having that role in a world when inflation is low and growth is low. They don't have a lot of tools, so maybe they can try to, let's say, boost wealth, spur demand, spur inflation. That's how maybe the Fed operated post GFC. But we're in a completely different regime now. The Fed's goal is, full employment and stable prices, as you mentioned, Jack. And right now, it's very far from its goal. So inflation is 8%. That's not where any central bank wants to be. So whether or not the asset prices are high or low, I don't think that's in Powell's mind right now. Right now, what they're really thinking of is inflation, and that means hiking rates and potentially beyond what the market is priced in, depending on, let's say, whether or not the Fed takes into account Larry Summers' view of the world, or if asset prices don't react as they are expected to. So,
or Bill Dudley's view of the world. There's another one, right?
Yeah. So Bill Dudley was very kind to spell it out for us.
Yeah, no, I know. Here's an interesting question for you, Joseph. When I saw the Fed forecast and I saw unemployment, have they given up on the Phillips curve?
I would have to assume that, that when you have the new framework, it basically moving towards a way where they wouldn't, hike rates in anticipate because the unemployment is getting too low. I think that kind of tacitly assumes that the Phillips curve is no longer valid. So yeah. I feel like that's kind of built into the new framework.
And it really depends on that Larry Summers labor force participation thought,
Yeah.
But I agree. I totally agree with you. We're in a world, they cannot suppress volatility. That's not their job anymore. It was their job in a deflationary or low inflation world. And now, in that world, you're absolutely right. The wealth effect could be transmitted through the stock market. But what I've noticed now that we've crossed the Rubicon and things have changed, is that whenever Powell says something, so like taking 75 basis points off the table, or last night almost reiterating that, the next day Fed speakers come out and say, well, we really haven't taken it off the table. We can always talk about it, right? So either the Fed, and this includes Mary Daly, who, remember, is the heir to Janet Yellen at the San Francisco, and Williams at the San Francisco Fed. So you wonder whether he's got a force of people now, or a force of Fed speak, that if the market reacts in a certain way to Powell, they come out with a whole load of, actually, yeah, this is what we think. This is what we think. This is what we think. And no, nothing's rolled out. Nothing's rolled out. Because it's happened a couple of times. We haven't had the full. I mean, today, I don't think it was Powell's interview last night. I think the market was just, it's Friday. You've got option expiry at the end of next week as well. The market is loaded up on gamma exposure. It was sort of, this was going to happen today. However, if you look at where we are, who cares? Everybody's going, 4,000 is going to hold. It didn't hold. Actually, the big level was 40.40. That didn't hold. We're still below there. And in fact, we could go up to, let's take the NASDAQ 100, NASDAQ Composite. We could go back up to mid 11,000s. Again, who cares? But I think there's so much wrong, and the Fed has got to write so many things, and it will be wonderful to find out, is that level just above pre-COVID where they're okay? And if we get down there, and I think what they're trying to do is make it a smooth move down, rather like the dot-com bubble burst. That was, that just took ages. If you're an equity investor, it was torture for ages. Fortunately, I was a fixed income investor, but it was a torturous thing. I wonder whether they're trying to draw it out and let it, that's the soft landing maybe he's talking about.
But they pivoted in 2000, right? They stopped hiking and then they cut.
Yeah, but that was towards the end of it. But think of, the dot-com, in certain respects, the dot-com bubble has certain, and I did some comparisons this week on that, had certain, and I think there's still 2 ETFs left over from that. If you look at that, then you look at ARK, and you look at some of the most expert, we've followed that quite well. But if you look at the broader market, it was a longer drawn out. Remember, we've only been going, what are we, beginning of May? And really and truly, we've only had real trouble in the last couple of weeks. First quarter was, we came down, but there was no CNBC or Bloomberg. Although interesting enough, there's a difference there. CNBC, shock and horror at the stock market.
Markets in turmoil.
Bloomberg surveillance, Tom Keene, John Ferrer, Lisa Abramovich. They're asking all the right questions. It's like, Lisa, I don't believe these numbers. Or I don't believe the market. Or what the hell's going on? Tom Keene, these are epoch-making, history-making. They're asking the right stuff, not necessarily what people want to hear. Whereas CNBC is all what people want to hear. So you have the great contrarian indicators there. So that's been very interesting to watch that difference. And, I'm sure one has a higher viewership than the other, which probably reflects what side of the markets you're sitting on. The trouble with the banks is they can't be too contentious. It's groupthink because their client base are not going to say, oh, I didn't like him, or I didn't like that view, because that's his job is based on. Or,
that company's a pile of crap, I'm sure, because they do business with that company. Yeah.
Exactly. So that you have, and then they're also hamstrung by, I suspect, editorial compliance. So if they want to get stuff out, it's hard for them to do that, right? It's really hard for them to get it out pronto. You probably had this on the editorial side at Real Vision when you were there, right? You do an interview and it's still 3 days later, but everything's changed. I remember Raoul asking me to write something on Brexit. I said, that's impossible, Raoul. You can't write anything on Brexit that's going to take 3 days for an edit process. I was in the middle of the peak of the Brexit issue. And it's not that I didn't want to do it. It was just impossible. So I think what we've tried to do, and I've been reading Joseph's blog and seeing, We're trying to keep it real time. And if we're saying things that people don't like, okay, but think about what we're saying and why you don't like it, and then we'll have a conversation. But there's too many fixated views. I mean, Zoltan, I think Zoltan at Credit Suisse now, I think Zoltan's just looking to upgrade his job.
To where? How do you? He's the macro god. How do you become higher than a god?
Chief, I mean, this is lunacy to think that you're going to have a commodity-backed Bretton Woods system. How can you do that? I mean, until the LME, until the regulators in London turn around and say, LME, get rid of your owner. You can't have the Chinese as the owner. Because had that nickel trader not been an insider, a she insider, say it had been a Glencore or a Vitol or an American, they wouldn't have been saved. All those trades would have been kept. So that's something that's wrong. So you can't, that doesn't function.
Sorry, what about Zoltan's theory that commodity firms, coal miners and the like, they hedge their books, so they have a lot of spot coal and they sell forward coal, and if the volatility can eat them alive, and Peabody coal's doubled over the past year. You expect Peabody coal to be minting money, but it had many $100 million loss because of all these losses. Zoltan thinks that central banks will have to bail the commodity markets out. What do you make of that, Nick?
Yeah. That's the bank's job, to work with the commodity markets. I mean, do you think the central bank should be bailing out Glencore, Trafigura, or Vitol? No, they have their bank lines. The financial markets exist to actually solve those problems. Don't give the central banks any more, because if you give them any more responsibility, you've got one big central bank that can't help, and that's the ECB. And in the end, given that the commodities are fundamentally a dollar product, you're calling on the Fed to provide swap lines potentially. So let the banks deal with that. It's better assessment. By the way, I made a lot of money on BTU, Peabody Energy. I mean, bloody hell. There is no crypto around that came close to what I think I bought it at $1.82 and sold a couple of months ago, but in the 20s. It's ridiculous. That is, that, and can I tell you something else? You can do large trades anonymously. You don't need crypto. You can put large positions on anonymously. So this was the craziness about this. This to me, yes, crypto's got a place. Maybe Bitcoin, as I said to you earlier, I think it's a tradable, investable. But there's so much else out there that you can really, if you do your work, research, it's there. There are great opportunities, long side, short side. I'm agnostic as to which way. Don't just narrow your focus and go all in. And I'm not arguing for diversification. I'm just arguing, do your analysis, pick the sectors, pick the things you like and you understand, and then, trade accordingly. You can't have, unless you're a computer, you can't have more than 20, 30 positions, right? And that's a lot. But
you can. They're just bad. They'll drive you crazy, and you'll lose money.
You'll make a lot of mistakes. But I think our objective, and I think this is where we've, sometimes people say, I think the world is definitely more sophisticated in certain respects, but I sometimes think that there's just way too much noise. I rather like the idea. Would Churchill have been a great orator in this period? He would have had to answer every time there's a question. Whereas some, great speeches of the past. And I just think that you've got to pull yourself back. And I think the fact that Joseph lives in Las Vegas is perfect. You can go off and satisfy any craving for, the wild side of the markets, and then come back and then just calmly view things and react accordingly. But you can't stress yourself out in this environment. You've got to just clarity. It's all about clarity. And if you miss a few opportunities, so what? You don't need to push it. Never push it either. I think that's the important thing.
Those are wise words, Nick. I just want to close by addressing a theory, Joseph, that you've shared with me, with our audience, that back in the day, 6 months ago, it was sort of fun to entertain this thought that definitely goes very contrary to mainstream economics. But now we're at a juncture where if this theory is correct, I think the volatility we've seen so far is just a drop in the bucket. And that theory, Joseph, is inflationary hikes. The theory that hiking interest rates could actually exacerbate inflation because it won't destroy the volume of reserves because we're in an ample reserve regime, but at the same time, it will raise the velocity of money. Tell the audience, Joseph, about that theory and how likely do you think it will happen? And then if that is correct, just how dire a situation the Fed and central banks will be in.
Yeah, so I have this view that rate hikes in the context of today's financial system can be inflationary. And there's two legs to this. One is the public sector leg, and the other is the private sector leg. The public sector leg has to do with the fact that the largest debtor in the US, well, actually in the world, is the US government. So what happens when you hike interest rates? Well, then the interest payments of the US government go even larger, right? Let's say we hike for interest rates. We're at basically around zero now. Let's say we go to 5%. Now the US government has about $23 trillion in debt. Some of it's long-term, but eventually it gets rolled. So that's a lot of interest payment that it has to do. And where does the US government get the money to pay its interest payments? It just prints it in the form of borrowing even more treasuries. So in that sense, you can think of it as kind of a higher rates as a pro-inflationary kind of a doom loop because the U.S. government just kind of spends and spends.
Wasn't there a theory a while back that was expounded? Joseph, somebody said raise interest rates to raise inflation. I remember that a couple of years ago, unless it was you.
There are MMT people who have this school of thought. That's actually not new. What I think is new that I think is that it could actually spur private sector bank credit creation more than it would be in a pre-GFC world. And the reason I think that is simply because the way that banks fund themselves in the post-GFC world is very different from they did pre-GFC. Now, pre-GFC, as you know, you're at Salomon Brothers, banks were very active in the money markets, right? So when the Fed raises its interest rates, that directly impacts the liability costs of banks. It immediately impacts their funding costs. So the mechanism was that their funding costs rise up, so at a spread, pass it on to the broader economy. That's how monetary policy works. The monetary policy transmission mechanism today is different. The Fed doesn't actually change the liability costs of banks because no one uses the federal funds market anymore. The Fed changes the asset returns of banks. So what the Fed is really changing is how much, let's say, the banks earn on the reserves, which is their opportunity cost. So that's really important because post-GFC, the liability costs of banks are about zero because after you've had quantitative easing and enormous amounts of fiscal stimulus, there's basically an ocean of retail deposits that pay zero. So when you're hiking interest rates to say 5%, the deposit liabilities, the funding costs of banks don't actually change very much. Deposit betas are low, so to speak, but the returns, the asset returns get very high, and that actually encourages credit creation. So in that sense, you have a pro-cyclical inflationary loop where the higher you hike, the more incentivized banks are to create credit. And that's what I suspect could play out. Something interesting that we saw in the consumer credit data recently is that a much larger than expected increase in consumer credit. And we're still very early in the cycle, and we just started hiking rates. But that's another way that I think that this could play out. So I guess we'll figure it out.
Is that why you think Powell and the Fed are they've gone from soft to softish? No, is that potentially why they've got a confidence level that they won't cause a real recession?
I think it's a bit too clever. I like Powell. I think he's doing the best job that he can, but I don't know if he would think that much into it. I think it goes back to what you mentioned, Nick, is that it seems like they're trying to smooth cycles, or rather the politics today just really can't accept any pain. It seems like, let's say 20 years ago, people would be able to understand there's a trade-off between inflation and unemployment. Today, any trade-off is seemingly unacceptable. I remember there was a clip.
It would be a Disney warning, wouldn't it? A trade-off. You'd have nowadays you have a warning in front of a Disney cartoon. Beware, there is a trade-off coming. Pain to come.
yeah, I don't think we can accept that.
Yeah.
It's a strange place we are culturally, but we're going to have to accept it one way or another.
Well, the pain is not going to be an economic slowdown and pain in terms
No,
of growth.
absolutely.
Well, they're not going to hit inflation, and that's going to be a lot more painful.
Like you mentioned, it's really the Bank of England that's being the most honest here. I'm not quite sure what's going on with everyone else.
Yeah, well, you won't get any honesty out of Frankfurt, for sure. None whatsoever. That may be controversial, but they're only just getting on board with it. Schnabel did a complete U-turn. I mean, 2 weeks ago, complete U-turn. And this was somebody that was focused on no, ESG isn't inflationary, transition will be good. Bang. Suddenly somebody in Berlin must have spoken to her, and that was it. Honesty is unfortunately in short supply. I think if they were truthful and open about it, but it's not the political climate to do it, and say, look, these are the consequences. We have to get the inflation down. I mean, even to the extent you could say, don't spend so much. Why is it a terrible idea for the Fed to say, don't spend so much? Keep your rainy day funds. We've got to get this inflation down. Boom. That's the forward guidance that they should be thinking about, as opposed to guiding the markets.
Well, the one thing we haven't talked about that much is quantitative tightening. Nick, it's been so great having you on. We should have you back and talk about QT, because I think that is the real player in this market. Nick, people can find your work on Twitter at @Glinsman, and they can also find your writings at intelligencequarterly.com. Tell people a little bit about what you write about and what people can find there.
Well, my writing, there's a bit of a team. We have a team, but I spend my time writing on global macro and the markets. So I can be writing. Obviously the last couple of weeks it's been very much stock market centric, bond market centric, but I can go into the commodities. I can venture into FX. So I literally can write about anything. I can even put a bit of politics in on the fiscal side and say this is going to be expensive and this is not going to work. Then we have, and that's a subscription. We try to keep that. Our website is for private investors. What we hope to do is explain things honestly, accurately, just the facts, and these are the consequences, and give some trade ideas. But it's all about, particularly now, especially since we've gone from suppressing volatility to you can't suppress volatility, it's going up. It's all about assessing risk, get rid of the noise, stay within the cognitive threshold, assess the risk. These are the facts of what's going on. These could be the consequences. And then what we do also is we have three other dailies in the macro book, which is European macro daily commentary and Asia Pac macro daily commentary, where the team look at everything that's printed in the foreign press, multilingual. If there's stuff that's relevant to the global thematic, supply chain, inflation, monetary policy, so on and so forth, they pull out the highlights, they make a commentary, and you're up to date in the morning New York time. Mine comes out a bit later because I like to do things after the stock market's open. We also have a daily special article each day on Asia Pac politics, geopolitics, because I think that's always interesting, particularly now, Sri Lanka, zero COVID, everything that's going on. And that one is still free. We've kept that as a free. And then we also have Tracy Schuchart at Shigo.
Okay. Amazing.
We're adding others, by the way. And Tracy does twice a week an energy piece, twice a week a materials piece. So that's metals, it could be fertilizers. And we've also got one of our guest contributors, whom I got to know when I was at Brevin Howard, Patrick Peregrine. Now, very intense, very academic. He is really deep. I think you've seen some of the stuff on the website, because it's not behind the paywall. A deep analysis on rates market, global macro, less on equities, but really economic fundamentals translated into the rates market. But where I found him really good, so when I decided to put the US yield curve steepener on for that trade, which is now closed, but I'm getting tempted again, he was saying it's gone too far, inversion. This has got to snap back, and then the snapback is going to cause pain for people who've got the inversion trade on. Oh, okay, next day. So we have Patrick put and you know, he's kindly does it. What we do is we do it a day after he's issued to all his clients. Some of his more thought-provoking, bigger picture things, and that goes onto the site, and you know, that's real added value. And then we've got a couple of guys who, and we're just starting to integrate this, who fuse fundamental with technical, and look for 3 to 5 trades, primarily in the FX market, but you know, it can go across the broad spectrum. And we're looking to add, we've got more people that we're talking to, all of whom will be names. But what I'm trying to create is not like, I think Substack is too much on it. I mean, it's a great idea. So we are bringing people in with a great deal, and we're trying to add content that will add value. But you have to sit there reading it, and you've got to do the work, and then that forms the basis for the retail market. But we have, you know, most of our business is consulting, and people get institutional type work down at the consulting level or down at the retail level. But it's an honest, you know, it's an honest reflection of the work we're doing and the discussions we're having. And needless to say, we're having discussions with some huge risk managers and money managers. And I think that's got value. And, you know, we've got plans to make, to sort of, you know, do something more on a regular basis in terms of podcasting or video. And that's slightly difficult in terms of how do you do that? Can we have a round table? Can you bring in guests who are specialists? You know, I mean, I've got this relationship with Ashok TV in the Middle East, based in Dubai, partnered with Bloomberg, and cool. Put Joseph into one of them.
I was on it. It was very, very interesting.
I gotta watch that.
You know, you go on, and I mean, I'm now onto the stage where once every 10 days I'm on one of these 1-hour programs. Last one was talking about the Fed hike and the reserve currency status. There's 3 of us, and one of the other panelists was Russian, so that was always going to be fun. There's me and the Russian, and Beiruti was definitely on my side. But you have instantaneous translation, and when you when you actually see the playback, it's fantastic. My kids were beside themselves with hysterics. I didn't know you spoke Arabic. I didn't know you spoke Arabic with a female voice, Daddy. But I think that, you know, the idea of a round table and having discussions and allowing give and take, it's an honest. That way you can. I mean, this is a great format because there's honesty. You can't go off on your own book and, you know, your own hidden agenda. Got to keep it up. That's important.
I'd also like to note that I actually found Nick's daily macro note before I met him, and you know, I read it and I thought it was really good. Like, I read a lot of stuff, and I just immediately thought it was really good, and I subscribed to it. So if you guys haven't checked it out yet, definitely worth a look.
Yeah, that's intelligencequarterly.com. That's different than my newsletter, which is unintelligent every single day. Where I don't focus, you know, Nick, you focus on just the facts. I focus on, my motto is just noise, just narrative.
Yeah. There was a Network. That was the film that had that noise, wasn't it? Yeah,
there we go. All right, well, of course, people should definitely check out Joseph's work at fedguide.com. His book, there's a small one behind me, Central Banking 101, really taught me so much. It's a good book.
Yeah, it's a good book.
It's a good book where it is a 101 thing, but if you're, you know, someone who's not intimately familiar, you like, to learn complex things, you sometimes are confused. But it's also the level where, like, you know, someone at Nick's level can read it and it's not too elementary. So I think I definitely recommend anyone, like, if you watch this or you watch any interviews with Joseph and you like what he has to say, you definitely should buy the book and read it. Don't just buy the book, read it. Okay. Yeah. And then also, Joseph is at FedGuy12 on Twitter. Gentlemen, thanks so much. We should do it again soon.
Look forward to it. Thank you very much.
Thanks, Jack.